Lyndsey, it's great seeing you. Thanks for joining us.
Yeah, Ben, thank you so much for having me. I'm super excited.
Oh, good, good. Well, I thought, a good way to start would be just to learn a little bit more about your background and then what you're doing at Blue Onion, because your Blue Onion is so directly tied to your experience. I think that's really fascinating. So if you don't mind, why don't you give a little bit of your background and then talk about Blue Onion?
Yeah, so I come from the finance and accounting side of the world. So I was at a company called Birchbox several years ago. So one of the OGs in the subscription business, which was super exciting. So I was there for 5 years. I joined actually as a financial analyst, reporting into the CFO. And by the end of the 5 years, so I was running finance and accounting globally. So it was an amazing opportunity at a startup. But along with that, there were obviously tons of challenges, which I'm sure your audience knows well about, just in terms of scaling, especially from the finance and operations side of the business. So we grew really quickly. We're operating in multiple countries, had a brick and mortar store, and then all that time we were on QuickBooks, and then we were trying to move on to one of these very legacy ERP systems. And so that was such a nightmare, that whole process at the time. And I thought, this can't be it. It can't just be QuickBooks and then I have to pay $1 million and spend 12 to 18 months of my life working on this project. And so that was really how I began to think a little bit about Blue Onion. And so ended up leaving Birchbox several years ago actually, and ended up consulting for a lot of different D2C brands in New York. And just kept seeing the same types of problems where at a high level, financial data lives across a company. It lives in all these different systems, and accounting and finance teams were still having to go into each of these systems, download CSV or Excel files and try and stitch all of it together just to close the books. And I
Right.
thought, this is crazy. And so decided to start Blue Onion Labs. And so really what we're building and what we built is essentially, a system for e-commerce accounting teams to help them automate a lot of those manual processes around collecting sales data and accounts receivable data so that they can close the books faster and more accurately. And so, for a lot of our companies, and I'm sure, with companies you've worked with as well, as the business grows, the accounting piece just becomes more and more complex, right?
Right.
You want to sell in a new marketplace. You want to open up a second Shopify store. You want to add all these different payment processors or a return service or a loyalty program or gift card. So all of these things, which are so awesome and exciting for the marketing team, but then everyone's like, "Oh yeah, accounting," at the
Right.
end of it, and it's a little bit of an afterthought. And so what we've really built is a tool to help accounting teams sort of keep pace with marketing
Mm.
so that you are able to go and do all of these things on the marketing side and the revenue generating side and not need to go hire a million accountants to try and deal with all of that.
Right. Well, that's awesome. And you raised a bunch of questions. And I just wanted to go sort of back to the beginning of explain maybe in more detail what is where's all this data living, right? Because it's inside payment processors, it's inside marketplaces, it's inside Shopify. What is the problem? Because I think in our experience, sometimes CEOs or leaders are like, oh yeah, whatever, and then they farm it out to a sort of a pretty cheap bookkeeper, and then you get this really weird combination of financial statements as a result. So what is the kind of specific problem of the data being in all these different places, and what is the benefit of getting a better handle on it?
Yeah, it's a great question. And so maybe even, if we think about even like a simple brick and mortar transaction, right? Like you go into a store, maybe you buy something for $20, you hand them $20 in cash and you get to walk out with that item, right? Fine, super easy. But now if we think even to, a simple e-commerce transaction, so Ben, maybe you buy a $20 item from your favorite e-commerce store, maybe they offer you a $2 discount, maybe you have to pay $3 in shipping, maybe you partially pay for that with a gift card or loyalty points, right? And then maybe you pay for it with PayPal or Stripe, the remaining balance. And then ultimately when they see that money in the bank account, it doesn't say here's, that amount from Ben. It just is a lump sum of cash.
Right.
And so already you have so many interesting data points around that transaction. But it's really difficult to essentially extract all of that. And especially if if you have a part-time bookkeeper who's just trying to, close the book. So, how do we take all of that information and put it in a format in a way that's organized and easy to understand for accounting teams? And
Right.
so what we're doing is we've built all these integrations into, whether it's Shopify, Amazon Seller, about 20 different payment processors, and then we go all the way to the bank account. And that's in addition to some of these like third-party apps around return services, gift card services, things like that. And so that people are, the question I usually get is, why didn't something like this already exist? And I think the really interesting part is, when I was at Birchbox, it couldn't exist yet because everybody was on all these custom systems. And so now with the
Right.
rise of Shopify, Amazon Seller, the ability to extract data in a standardized way through different APIs, specifically within the payment processors, just gives you so much more ability to pull in that data.
Right.
But the one thing I'll say is that it's not just enough to take data from one place, as you know, right? And like dump it into a different system or QuickBooks or something like that, because that's only half the battle. The
Right.
hardest part is really around the cleaning of the data. And that's really the part that we're focused on automating because we go all the way to the bank account. And so, the accounting term of reconciliation comes to mind, where we are cleaning that data. And when you see that order in the order system, the refund, we tell you exactly how and when it gets settled into your bank account and if it doesn't. Because that really is the thing that helps identify where things might be missing, they're going wrong. I mean, we've seen a ton of different cases of things where they weren't lining up. And so to be able to help and flag that for companies can be really helpful.
So so there's a problem sometimes where it's not being done properly, and you're missing money that you should be getting, and then maybe there's a. It sounds like there's also a problem of like you're getting to cash or an accurate prediction of cash because you have to all these different delays. Like so, I sold something on Shopify today, but I guess I don't get it for 3 days, and but let's say I had to close the books in the meantime, or a new month happened. You now have these like weird cash balances, right? Which can make things scary, especially if you're operating in this environment with low profits and cash is tight.
Yeah, exactly, yeah. And that's the other thing that it was, we've worked with some companies that thought they were going to get, let's just say, $1 million this week, but then they only got $900,000, right? Like, and then they're like, what happened? And so it's not as simple, unfortunately, as, I sold this thing for $100, I'm going to get $100 in the bank account. There's a ton of different steps in between there, whether it's payment processors, whether it's returns and refunds, whether it's, non-cash payment methods being used like gift cards or exchange credits. And so to be able to have a grasp and really understand, what is the breakdown of my fees and what actually is the true cash that I can expect this week can be so helpful to your point, especially as we get into this new, I'll call it new operating environment
Right.
for e-commerce companies where cash is so important and you're looking for every little thing you can on the margin side.
And if you have seen discrepancies that large where people miss by 100K.
Yeah, and part of it, sometimes it's just, I'll give maybe two examples. So,
Yeah.
one is, sometimes for some of these companies, they're moving really quickly. Like we've seen companies go and set up new payment processors and not necessarily tell accounting, right? And so maybe
That's
there's
a good
this
idea.
PayPal balance sitting somewhere, right? Maybe there's a balance in Amazon Pay where nobody really knows, right? Like the
Right.
accounting team doesn't know. They're missing this money. They don't have access to it so that they can sweep it into the main bank account. So
Yeah.
there's sort of just like a process piece. And then on the other side of that, what we've also seen is, in some instances, a lot of times it has to do with how customer service is processing some of these refunds or issuing different credits. And so, if they're doing it at the payment processor level, but the accounting team's using, the order, let's say Shopify, to pull in their refund amount, and they're missing a bunch of refunds, that's very jarring for the team to find out,
Right.
when they're like, where is all this cash? And that's usually what we see. And that's sort of the initial or the early indicator, is that you have this balance sheet amount of, whether it's cash in transit or undeposited funds or whatever you want to call it, that just keeps growing every month and nobody's quite sure why. And
Right.
so that's usually a really good time for us to come in, because there probably means something's happening that's not being accounted for either correctly in the financial statements, or there's some sort of process mismatch happening somewhere.
Wow, that's interesting. As you were speaking, I was also thinking about the problem of loan covenants, where you often have to maintain certain levels of cash or ratios, and depending on what measure the lender's using, like for example, if they were looking at your bank balances, you would actually have far more cash. It's just a couple of 2, 3, 4 days a week out than they see, and you could inadvertently trip a covenant because you weren't sort of properly allocating. Whereas with your system, you can say, no, 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 let's use the full accounting. It's going to come in. It's just 2 or 3 days behind.
Yeah,
Interesting.
exactly. And I mean, that's it. Some of the other things that we're seeing too is, there are some of these loan facilities where you have to deposit into that loan provider's bank account. And
Yeah,
so really there's a lack of visibility
yeah,
in terms of like, what cash am I getting? Where is it coming from? If I can only see the sweep, into my main bank account like a week later or however
yeah.
many days later. So it's really about that visibility, having a really good grasp on, cash. And the other thing too, I'll say, especially as we think about this new economic, operating environment, like gift cards is another thing
Mm.
too, right? Where it's like, did I already sell all these gift cards maybe around holiday, and I've already collected that cash, and now they're coming up for redemption, right? In which case I'm going to get no cash for a lot of these orders. Or maybe
Right.
on a more positive spin side, right? Like I'm going to sell all these gift cards and get a lot of cash up front. And so just want to make sure I fully understand what that means for my cash flow forecast.
Boy, that's interesting problem. Right. I can. So everybody does that. Like, I'm sure. Well, do you guys do that? Do you have sort of gift card redemption predictions
Yeah,
in your
yeah.
system?
So
Wow.
we show all of that. So we
Yeah.
show all your gift cards sold. We show gift cards. This is the other fun thing we've seen a lot, is complimentary gift cards that are issued, whether it's for
Right.
like a marketing program or influencers or something like that. So being able to understand and really see that liability that's outstanding,
Right.
that maybe it's a little bit hidden and sometimes hard to find.
Right. And what are the outputs of Blue Onion then?
Yeah, and so the biggest thing is, if you think about it, we're taking all of your order system data, all of the payment processor data, and then going all the way to the bank account. And then we're cleaning all of that data because we go all the way to the bank account. So now we have this really clean set of transaction level data, and we have a couple different outputs. So we try and present it in a way that's very helpful for finance and accounting teams, because that's really what the product is built on, my experience.
Right.
All the experiences of, the 150 e-commerce companies that we work with today, and really having a tool for finance and accounting teams, because that was the thing, is that I always felt like marketing had a tool, the engineers had a tool, and it was, what can I see in a way that's really helpful for me and for my process on the finance and accounting side. And so with that clean data set, we can do a lot of interesting things. So we automate journal entries, and we suggest different journal entries based on the accrual method. So, in and out of deferred revenue recognition, things like in Shopify that can be challenging to pull out order tags. So you're able to group your transaction data
Mm.
in lots of different ways. Information around refunds, deferred revenue waterfall schedules, gift card balances, and then we also have what we call, like a bank rec, essentially, which is, here's my deposit, in the bank account. I can see $123,000.52. You can click into that and see every single transaction, every single fee
Wow.
that makes up that. So, like, as you're thinking about like an audit process,
Right.
it makes it a little lot easier than needing to go and try and do that whole revenue sample and tracing it to
Right.
the bank account. So we try and automate all of those things so that your monthly close process, or we have companies that do weekly close processes, are really easy and fast.
Interesting. And I would imagine you could handle things like mixed order carts, right? Where you're shipping at different times and things like that. That becomes
Yes.
ultimately a journal entry and an account. That you,
Yeah, exactly. And that's really around the presentation of what we have around deferred revenue. So you'll be
mm-hmm.
able to see everything that's sold. And then as it gets fulfilled, we will show you recognized revenue. And so whether you have split shipments, or let's say it's Black Friday, Cyber Monday, and you sell a bunch of things in November and you don't ship them until December,
Yeah.
we'll be able to show you all of that information, and also things that have been lingering for a while too. Like let's say you sold some stuff in March, and for whatever reason it still hasn't shipped. We'll show you that unfulfilled balance so that you can look at your balance sheet and say, okay, does all of this, line up? And the other thing I'll say is where it's been particularly helpful, I think, with some of the supply chain issues that companies have been having is if they're doing pre-sales, for example, and they already collect that cash and they've taken the order, what's still open and outstanding and to be fulfilled. Again, so that they can have a really good grasp on, cash flow, what that looks like. I've already collected this cash, but I still have to fulfill these items and ship them. And, again, I think it'll be a really interesting environment for companies to operate in soon.
Yeah. Yeah, that's for sure. Where does Blue Onion stop? I mean, you're it's a big product, and you're doing a lot of really cool things. Like, where do you sort of like draw the line? Like we're not tackling inventory, or we're not doing, you know.
Yeah, it's really interesting. I would say, I this idea of reconciliation can be applied to, I think, a lot of pieces of the income statement and the balance sheet, which is when we think about it, it's I have this transaction and it hits multiple systems. So how
Mhm.
can I trace that transaction across those systems and then generate the data I need for my accounting and finance processes? And so, for us, inventory is definitely something that we hear a lot about and is, not for this year, but certainly, on the roadmap for us. But I'll say, where we stop is really around the forecast side. So that is
Mhm.
really, I think there are a lot of other tools and things like that out there. I think for us, we are really focused on how can you get the most information out of, this historical data, and how can we help you close your books faster.
Yeah, yeah. And Lindsay, who's a good customer? Like, what indicates somebody's like ready for you, or of the size where it makes sense?
Yeah, definitely. I'll say we have sort of what I'll call two sets of customers. So we think about if you are an e-commerce business and you're about $10 million to, let's call it, like $150 million. That's sort of our sweet spot, our bread and butter. And you have somebody in-house on the finance and accounting team. And so that's usually who we're working with. And I'll say that's sort of like our one group of customers. We're actually working on a NetSuite integration, so that may even eventually, the revenue number, I think, will eventually get higher as we see more companies, as they grow, right, move on to an ERP system. But then I'll say that like $1 to $10 million. So we thought, right, like if I'm a business owner, I have less than a $10 million business, I have a million other things I'm focused on
Right.
than like closing the books on an accrual basis. But what we've seen and where we can be really helpful is a lot of those companies use fractional finance and accounting companies
Yeah.
or bookkeepers. And so, we work with a lot of different, fractional firms that maybe are helping close the books for these companies, and they're doing it like 10, 20, 30 times a month. And so some of our clients actually are these fractional finance and accounting teams.
That's interesting. Wow. Okay. And I'm sure everybody who's listening would want to know, like, well, what's this going to cost me, or can you sort of share roughly what how the pricing works?
Yeah, totally. And so pricing is based off of basically your revenue. So that was because this is a tool essentially. If you're $1 million all the way up to $150 million, that we really believe can be helpful for your business, and so wanted to make sure that it's affordable for those operating in a $1 million budget versus $150 million budget. And so because a lot of what we're doing is around transaction volume, we thought the easiest way to price it would be based on revenue, and
Right.
so it can range from $500 a month up to, $4,000 or $5,000 a month.
Well, that seems like, so I'm sure that the customers look at this as like headcount replacement, right? I mean, like, what other choice do they have besides hiring people to do this for them?
Yeah, and that's really, and the funny thing that we've seen though is that it's nobody is like super excited to hire that like third, fourth, fifth accountant.
Right.
And also, right? And so, and actually, a lot of what we see, which is not that surprising, but we see really lean accounting teams where you
Yeah.
have one or two people that are doing everything and they're tired. And I don't blame them. That's a ton of work for the complexity of accounting for an e-commerce business. And so the way that we've seen it and the way we like to talk about it too is like, how can we empower them so that they don't have to do this process at month end and download all of these things and try and put it together in an Excel worksheet, because there's a million other things they have to do and would rather be doing, honestly, than this like reconciliation
Yeah.
process.
Let me just like switch gears, like sort of briefly. Like, I know one of the benefits is faster close to books. I don't think a lot of CEOs or leaders of D2C brands appreciate why that's important. So, why is that important?
Yeah, it's a great question. And maybe I'll talk a little bit more about like when it goes wrong, right? So I think there's a couple different things. So from like a purely process perspective, right? Best practices, best in class finance and accounting team to make sure when you want to do that debt raise, when you want to do that equity raise, when you need to get through that audit, it is not the worst process of your life, right? Like it is best practice. And then I think the other thing too is, and where we try and come in is, you want to try this new thing. Marketing wants to try this new thing to generate more revenue. You want to try and sell on Amazon Seller, UK, for example, and open up a Shopify wholesale store. So we can help with that. And so eliminate a lot of that additional work that you would, knowingly or maybe unknowingly take on the
Right.
accounting team side of it. And so, we want to make sure that those things are always easy for you so you guys can move at that same speed that marketing's moving at.
Yeah. But I'm going to press a little on the time to close because we've run into some customers where it's like it's not just like, oh, it's 27 days later, it's like 90 days later. It can be really long, right? And like, what are I think the customer's sort of like, well, look, I can see my cash, I can see the cash in the bank, I kind of have a rough idea. I have your model, the Bainbridge model, like, I'm, I'm not going to press that hard, or I'm not going to really spend the money to speed it up. So, but there is real dangers there. But what are those dangers? Like, if you were, advising that, not Blue Onion, but you're advising that CEO, like, what would the dangers be? You're just like, you could really miss badly and get yourself in trouble and not even know it, or
Yeah, I mean, I think that for sure, right? Like again, what you learn from an accrual basis is very different from what you see just on a cash basis from like a finance and accounting perspective. And so, and again, having clean books, I think is, it can identify where things are going wrong. So let's say you wait 90 days and let's say there is something wrong with refunds where you're double refunding customers accidentally in certain things, or you're not collecting the sales tax that you thought you're like, those things can result in real cash outflows and real cash losses that you've now waited 90 days to be able to even see, let alone fix. And so by having those things and doing this process is sometimes annoying as it is of reconciliation and verifying all of your transactions are, happening in the bank account, everything's sort of flowing as I would expect it to, you're able to identify any discrepancies a lot faster.
right.
And then the other thing I'll say too, as companies grow, it was always one team's reporting this revenue number, another team's reporting this revenue number, somebody else has a different number in mind. And sometimes those differences can be really meaningful.
Yeah.
And so if you're trying to plan around those things, I think that, that you also get a risk, right? Maybe inventory is planning against a different revenue number than accounting and finance are seeing? Like, if so, why? Why is that happening? Why are people using different numbers?
Right.
And then, anytime you want to provide any financials or look at a forecast, if you have even, stakeholders where you're like, I'm going to hit this revenue number for, this fiscal period, and then you wait so long and you don't realize, right? Like, oh, that actually
Right.
wasn't my revenue number.
Right.
I offered all these discounts, or I had, a huge number of refunds or whatever it is, right? And now it's a little bit too late,
Right.
is what we've seen.
Right. What's the when do you see people moving off of cash to accrual? And like what's your recommendation there? I know this is not your typical customer base, but there's a tendency I think when you're just getting started to be like everything's cash. Accrual seems
Yeah,
cool.
yeah, and I'll say maybe depending on sort of the type of company. So if we see like a venture backed company and maybe they're just starting off in terms of the revenue side, but they're like, okay, I know I'm going to have to move here, and then they have somebody on the finance and accounting team, they're like they're already there, right?
Right.
They're already moving to accrual basis. Versus I'll say if you are, if I have my own sort of business just personally, and I'm like, like this is mostly for me, cash basis is fine. I'll say usually that's probably fine up until about $10 million. And so I think it's
Oh,
really,
that high?
I mean,
Sorry to
sometimes
interrupt you, but I was like shocked. I thought you were going to say like 500,000. I was like, whoa. Okay.
yeah, it depends. It really depends on sort of like who your key stakeholders are,
Yeah.
and I think the personal comfort level. If
Right.
you as the owner proprietor are like, I fully grasp this and I don't necessarily need to see those things, and I'm a one person show and this is more for my personal income, then you're probably fine to
Right.
wait longer. So I think it just depends. We've seen companies just starting out that are like, we need this right away. We've seen companies that wait until, they're $10 million and they're like, okay, now I really need to get my books in order for
Right.
many reasons. So it really just, each company is a little bit different.
I'm going to totally switch gears. So, given your experience, and then in this really unique position, you said 150 customers, I think, right? So,
Yep.
what everybody is worried about this environment, the new operating environment that you're calling it, and one of the things that Bainbridge is totally focused on and talking to all of our customers and prospects about is like profitability. How do you get to profitability? What are some of the things that you've seen, that companies can do, and how should they think about the process?
Yeah, and I'll speak maybe more from my consulting slash Birchbox
Yeah.
experience
Okay.
for this one. And so it always makes me laugh a little bit when it's like, okay, now we need to be profitable. Everything's changed,
Right.
right? Like from again, maybe just from the finance perspective, I'm like, that should always have been, the goal
No,
is,
that's what we had the
is
VCs for. Like,
right. Right. And so you always want to make sure, no matter what the environment is, that you're
yeah.
building towards a sustainable business. I think that's even more true for, e-commerce companies. What I've seen in terms of, I'll say one of the guardrails that we've seen, or where companies maybe sometimes go wrong. So sometimes what we'll see is, in my past, 2 years as a company, I have a repeat rate with customers of this. So I can reasonably assume that the next 2 years are going to be same as the last 2 years, right? And so that then determines, okay, here's my expected LTV, so I feel really comfortable, going up to this CAC.
Right.
And that can be really dangerous, right? Like if something meaningful shifts in the customer behavior. And
Mm-hmm.
so, and then again, with all of the changes to Facebook and Google and everything else that's happening right now, I think, one of the guardrails that I used to put in place, at least for newer companies where they maybe didn't even have that retention information because they were so young, would be, are you making money on every order, right?
Mm-hmm.
Like you should never be in a position where you're losing money on every transaction. And so part of that is really understanding, okay, what is my gross profit on, this order? Do I have a really good handle on my cost of goods sold? What is my return rate? And then how do I compare that to like this cost of customer acquisition? And when I look at it and I'm going to assume that I'm never going to see this customer again, and hopefully you will, right?
Right.
But I make the assumption that I'm never going to see them again. Am I still making money on this order?
Right.
So, and Ben, curious to hear about your experience
Well,
and advice.
I'm like obviously like thinking of the exceptions, or but like what about a subscription business?
Yeah, it's true. I mean, for certain cohorts or for certain types of business, yes. But even then, I would at Birchbox, I would not argue against it, but I would still be very cautious in that approach,
Got it.
making the assumption that even churn rates, right, are still going to hold because I sell this thing monthly.
Right.
And depending on, whether it's, a change in product or the operating environment or competitive environment, things are changing and can change pretty quickly. And so
Right.
just making sure, or at least sensitivity testing, I think those assumptions around retention, even for
Yeah.
subscription companies, is super, super important.
Yeah. Uh, I mean, we're huge believers in understanding the repeat purchase rate, and then so much flows out of that. And what the mistakes, it was really interesting and gratifying to hear you say it, because if you start with, okay, what are my current customers going to do for me into the future, and you overestimate that, then to hit your goals, you have underestimated your ad spend, right? Because you're going to
Yeah.
have to spend more money to make up new customers, but you're probably going to buy too much inventory,
Yeah.
thinking those things. Then if you get it the other way, which is probably more true a year or so ago, and you underestimate it, then you don't buy enough inventory and get stock outs, and you miss out on all that revenue. And what we'll see people do is, that, like you said, like, oh, our repeat purchase rate is 5%, so therefore it's 5% into the future, which isn't really true, right? It's like cohort by cohort, month, that doesn't impact all these things. And then, even that doesn't factor in changes in the product mix or discounting strategies, or, and your promotion environment or your ad environment. So people are like, oh, I had, like if you change your product mix dramatically, all of a sudden, like, that retention rate. So how would you do that? You would just run sensitivity analyses to say, I'm going to decay the retention rate faster and see what happens, or something like that.
Yeah, but I mean, and I'm sure you guys are probably doing this with your clients too. Is just like, what's my low case, what's my high case, and sort
Yeah.
of what's my base case, and continuing to evaluate that on a regular basis. So you're able to identify if there is, certain things that are not looking as good as those projections, so you can really move as quickly as possible on there. And then the other thing that you said that actually resonates a lot is really on the inventory planning side. So, where we see, or where I've seen companies, put the most money and resources, right? It's really around inventory, cost of goods sold, marketing expense, and then payroll. Those are like the three buckets. And I used to tell my companies, like, if you get these three things right, you will be in a great place. You will have a
Wow.
great business if you
Yeah.
have sustainable revenue, strong unit economics, and an LTV to CAC that makes sense, and you manage your working capital. You're there. That's the easy part, is saying it. The hard part is actually doing it. But I will say that thinking about, again in not in a new environment, but maybe being more aggressive in terms of, what are my payment terms with my manufacturers or my
Right.
suppliers, right? Like, how can I try and, get that revenue as close to when I have to pay the cost for that inventory, for
Yeah.
example, right? So, are there things that I can do there? Gift cards are something that I always recommend to companies as well, just from like a working capital perspective. Gift cards are essentially, a loan from your customers, an
Right.
interest-free loan. So, can you get that cash up front? But really, on the inventory, the supplier side, can you rethink those terms?
Yeah.
Less deposit up front, more, net 30, net 60, whatever those payment terms are. Can you negotiate those out further? And then to your point, like really being thoughtful about the inventory mix, right? What is evergreen versus what is seasonal? How quickly am I turning that inventory? How long is that inventory in transit? So I think that was one of the things that, for a growing company that I wish that we had invested in earlier was really hiring on the inventory planning side, just given
Interesting.
how large that, that bucket of spend is. And we always made hires on the marketing side, right? Because
Right.
that was so important. But sometimes people forget, like, so much money is going into the inventory planning side.
Yeah. Yeah, and it's so hard. I mean, there's platforms that do it, but you still need good people because you're making. Yeah, I mean, we think about like our apparel customers, and I'm like, oh, I don't envy that job.
Oh my gosh, I
Variants.
That is, I know, that's the one thing with returns and returns in transit, what's the buy, all the sizes,
Yeah.
all the SKUs. It is not easy. And then on top of that, right, it's not just enough to just plop it into a spreadsheet or a tool and roll everything forward, right? Because then you have to account for, what's seasonal and what are the tastes and what if this sells and what if that doesn't. And so there's just so much complexity around, planning for inventory. And that's why I usually say, like, if you can afford to hire somebody earlier rather than later in that key function, it can unlock a lot of additional cash for
Yeah.
you.
So okay, so there were. I think I heard four things. There's number one is making sure you get your retention rate correct and you stress test it. Particularly on the downside. And number two was inventory, being really good about planning and not overbuy. Well, I guess being good about planning. So what the issue is just not overbuying and tying up too much capital.
Yeah, I think it's, thinking about the working capital
Right.
implications, but it's also buying enough
Yeah.
to support that revenue number too, which I've seen also happen where it's like, those two things were so disconnected, the person making the POs versus, the finance team. So making sure sort of all of that is working together. And I think
Yeah.
that goes back to making sure everybody's using the same set of numbers is
Right.
usually
Right.
a good place to start.
Right. Then three was profitable customer acquisition, or really
Mhm.
understanding your payback periods and
Yeah.
your fully loaded CACs and LTVs. And then four was payroll. Is that those? Okay.
Yeah, headcount.
Yeah. Why is it that I think maybe this is like a function of kind of VC funded or companies that you often see this more in like New York and San Francisco and the kind of hot, or what used to be hot VC funded D2C markets. But man, they would hire like crazy. Is it
Yeah.
just like too much money on hand, or what? What was
I
that?
think Yeah. I think it's too much money for sure. And I think it's also those revenue expectations. It's too much money, and then once you take that money at that valuation, there are, very specific high, sometimes maybe unreachably high revenue targets that
Yeah.
you need to hit. And so, thinking really deeply about, like, is my business, does it need to be VC backed? And if
Right.
so, why? Or, and that's not to say that you can't build a large, amazing, e-commerce company without VC money. You definitely can.
Yeah.
I think it's, just being thoughtful about, is that the right type of money for me to take? And if so, where's the scale coming in later? Because I would say that's something else that I've seen, and I've made the mistake myself is, when we're this much in revenue, I'm going to get these economies of scale,
Right.
which, maybe, Birchbox are selling a $10 box, so maybe that was a few pennies, right? But what I didn't account for was shipping increasing every year by 10%. So,
Yeah.
like thinking, and I would say being too optimistic about what that means and what you think you can
Mm.
leverage, right? And given an inflationary environment, I would maybe really caution against that, because we were like,
Right.
okay, well, I'm going to acquire all of these customers so I can get scale, so I can save on the COGS, and then my margins are going to make sense. I would just say proceed with caution there.
Yeah.
Yet to see that work out.
Right. You mentioned the inflationary environment, and one of the things that I think this is probably a drum that I beat more than officially at Bainbridge, but like I have this feeling that a lot of founders are too hesitant to raise prices, and you know uh, it's too bad, right? Because like I mean I get the fear, but on the other hand, like if you're built like Hermes is with a Birkin bag uh, goes ahead and raises prices, 200% a year, or like, so if you have a real brand, you can do that, right? Or you should at least try it because it's just like it's the biggest shot in the arm to your EBITDA that you could possibly do, and you can do it tomorrow. As opposed to like, oh, let me rework my fulfillment system, which is like an 18-month project. Why? I mean, do you? First of all, I guess do you agree that people are maybe too hesitant to raise prices, and or what do you think people should think about in terms of that?
Yeah, it's a really good question. And yes, I think it's incredibly scary to raise prices. And again, especially when you're like, okay, I need to hit this revenue target. Am I going to lose, or am I going to have a lot of angry and upset customers, because of this price change? And so I think, part of it too, like Birchbox, it was really challenging because everyone knew it was a $10 box
Right,
every month. And so changing that was like a very big change, and it required a lot of teams and customer service and everybody sort of to get involved. But at some point, you can either be, I think, proactive about it, and say, okay, I'm going to get ahead of this. My shipping costs have, gone from X to Y, and this margin no longer makes sense. And right, if that margin doesn't make sense, then your CAC probably doesn't make sense either. So like
right,
really thinking about like they're all so interconnected. So I'd say not to be afraid of, increasing those prices, or trying to figure out like what are the products that maybe would have, outrage isn't the right word, but where customers would just be like, oh, or maybe not notice, right? And sort
right,
of what is that price increase?
right. It's um Yeah, I'm gonna butcher the quote, but there's that like great like Warren Buffett quote about raising prices, and the companies he likes to invest in are the ones that can raise
Yeah.
prices. The ones he avoids are where they have to have a prayer session just to raise prices like
Yeah.
10%. And not everybody has that luxury. I mean, if you're more commodity or you have this like known for $10 a box, but a lot of the D2C brands, like you're building a brand, and there should be more to your brand than simply the price, right? Um, and I don't know. I just haven't found a good way. Like, I mean, maybe we just have to model it out for people and like, oh, okay, that really could help. 8% price increase would make a big difference to this
Yeah.
business. We should
Yeah.
do that.
And how it flows through everything too, right?
Yeah,
Like yeah, it's crazy. If you can raise prices,
yeah,
I think it's at least worth testing. And again, especially in this environment.
yeah. Well, the other thing, around that is like the problem with inflation is that it impacts your P&L at every line item.
Yeah.
So it's not just like, oh, inflation's at 8%. It's like, no, it got more expensive to get it out of to do it in China, to get it over here, to get it to the ports. Your cross country shipping, your 3PL, your shipping. It's like it just adds up. Your
Everything.
people costs are going up. And I think it's hard for people to sort of wrap their heads around that, but there's this like multiplier effect inside of your P&L that is, if you don't do something about it, you can't just sit there and crunch your margins down. I mean, we're in the business of supporting customers that are in challenging margin structures, right?
Yeah, definitely. I mean,
That's
the
another
the
thing. Sorry, go ahead.
yeah, I mean, the other thing that sometimes I'll encourage teams to do, and again, easier said than done, which is
Yeah,
something I always appreciate from coming from the finance side, but is there a way to meaningfully increase the average order value? So,
yeah,
and is there like a bundle that we could offer? Is
mm,
there, something we could do? And again, looking at the analysis and saying, okay, this costs me X, but maybe I can offer it for a discounted price if it's purchased with Y.
hmm,
And so thinking about, right, like, because then that will help offset, maybe the shipping and fulfillment side of things. So thinking of like breaking down those orders and then thinking through, like, is there either a merchandising or marketing strategy in there
hmm,
where I could maybe like still increase the margin on, an average order?
right. Well, certainly reducing discounts is really interesting. You just mentioned that, and I mean, we've all seen it just in the past year. Like you used to go on sites and be like 20% off, 25% off, and now it's like 10%, and it's like is the standard. Um, and have you seen good ways of people doing analyses around discounting? Because I think so many times people are like, oh, we're behind, let's run a discount, which can be a slippery
Yeah.
slope, right?
Yeah, and I would say the part of the danger there too is like only measuring yourself at your gross revenue as opposed to your
Yeah,
net revenue. Like, don't do that.
yeah, yeah,
Always holding targets for the team, right? Because I once had this marketer that I absolutely loved, and she's like, you know what? Let's just do a 40% off discount. She's like, I'll hit my gross revenue numbers that way, and I was like, yes, but then all those orders are just going to be unprofitable.
yeah,
Like, do we really want to do that?
yeah,
So yeah, I think that looking and understanding, and understanding with marketing and merchandising too, what is the, I'm going to say, like, right discount strategy? What is the right cadence? Is it only on certain holidays? Is
yeah,
it, it's it, and to your point, right? I think that we've seen a lot less discounting happening just
yeah,
given the environment, but being really thoughtful and creative about how you are using discounts. And the other thing is part of that too is thinking about who are your best customers, maybe who are your worst customers.
yeah,
There might be some customers where they buy one thing and they always return it and they
yeah,
have the heavy discount, and thinking about like how some of those promotions maybe encourage those bad behaviors or bad types of customers
yeah,
that maybe you don't need and would be more profitable without, even if, right, like your top line takes a hit, maybe from a profitability perspective it makes more sense.
yeah. Absolutely. I mean, we have a tool that allows you to segment your customer base by any attribute, and then look at that segment on a contribution profit basis, and then you can go like, go give me the top decile down to the bottom decile. And our argument to customers is like, look, if you want to get more profitable, one thing you should do is figure out who your most profitable customers are. Now you attract more of them and encourage more of that. But let's figure out who your worst customers are and get rid of them and stop doing those things, right?
Yeah.
Because they're killing you. And I mean, not that, look, there might be a value of the person that only comes to the site and buys on sale. Fine, you can unload your inventory to that person. You don't want to get rid of them. But to your point, like encouraging the discount plus returns plus, it'll kill you.
Yeah. Yeah. And I think the other thing too is just like really thinking deeply, depending on the business, like the types of returns that you are getting, are there
Mm,
things that can mitigate, you know, that higher return rate, right? Like if it's obviously especially with clothing, but like, how can you better communicate, the sizing, for example, or the material, or, and really thinking, are there levers there? Because I think that's a little bit of not a hidden cost per se, but it's something that can be really expensive depending on, the vertical that a company is operating in.
yeah, interesting. I'm gonna go totally trendy on you. So, has anybody asked you how to model and think about NFTs?
Oh gosh, not yet. No, we have had one company ask us if we could help reconcile their crypto payments. And so I think, I don't think it's too far away. We're not there quite yet, but I think that we are looking, to into that space from like a payments reconciliation piece again of like if customers want to pay this way, then companies want to accept it, and then how can we best support our finance and accounting teams. But
Yeah,
no, not the NFT piece yet.
but it's. I mean, it's sort of. I'm sure somebody's got this problem, but if the idea behind the NFT is like, oh, it's a kind of a loyalty program, then that's a really interesting and hard accounting problem. I mean, I remember the days when the airlines, were building these huge, everybody started doing their mileage programs, and then you'd read, their earnings reports, and it would be like, I can't even remember the stat, but I remember one from like United Airlines like 15 years ago. It was like, if everybody redeemed their miles, we'd be flying people for free for like 24 months. It was like a massive liability. And I don't think anybody like people are like, oh, loyalty programs, this is cool. But I don't think people realize that around like it's sort of like gift cards on steroids, right? Um, like how do you
Yeah.
think people are gonna have to deal with it? Like you promise what do you think they're gonna do? Or do you think they're
Yeah.
just gonna do it and then deal with the consequences?
Honestly, the way we see it is that they'll do it and then they'll deal with the
Right.
consequences later and hope that there's like a relatively high-ish expiration or that it's attached to like a high order value.
Yeah,
Um, but I mean, yeah, loyalty points at Birchbox too are really, really expensive,
really.
because we were at one point giving out points for, if you reviewed your subscription box, and we gave you more points if you reviewed a product that you bought. I think there were even points for referrals, like anything that we wanted to do to encourage really good behavior. But then looking more deeply at the program, it was like a deeply unprofitable program that, to the earlier conversation, like a lot of customers that were the least profitable customers were, really using. And again, every company is different. So it's not to say that like every loyalty program, generates, the worst types of behavior. I don't think that's true. I think you just have to be really cognizant of, how are you using that loyalty program? What is the cost of that? And I think, in this new, Shopify ecosystem, like you don't have to go and necessarily like build, right, like your own custom loyalty point program.
Right.
You can, and there's all these different third party apps, right? And so you just want to make sure that you're accounting for those things correctly because to your point, right, if you end up in the airline situation, you might have a real cash problem, if everybody decides like, oh, I want to go redeem these in the next, several months.
Right. And they're not redeeming them on your worst stuff, they're redeeming them on your
No,
best stuff.
that's right. That's right.
You're like, oh, that profit went away.
That's right.
Well, thanks, Lyndsey. This has been awesome.